Well, hello everyone. Matt and I are joined by a good friend of mine who I've known for a long time, Dr. Wes Gray from Alpha Architect today. How you doing, Wes?
Doing great. Emmett,
Yeah,
Matt, appreciate you having me.
sure, sure. So Wes runs a firm called Alpha Architect. I think you founded it, when I first met you around that time. When was that? 10 years ago, 12 years ago, something like that?
Yeah, it's 2010 now, and I had another permutation of it even before that, 2008.
Hmm.
So whatever that is,
That was
13 years
Empirical
ago.
Finance or something. Yeah, I remember that
Yeah,
one
yeah,
too.
yeah. And
Yeah.
then I got sued on a trademark issue, and I had to change the name. But
Oh,
that's
yeah, I
a
remember.
long,
That
yeah.
goes way back. I was working in support at Interactive Brokers and kind of helping you guys get your accounts open from time to time or whatnot, or put on
Yeah,
trade strategies or whatever. Yeah, it was interesting.
yeah,
Yeah,
exactly. When
we
we
go
had
way
like,
back.
yeah, when we had like $1 million AUM.
Yeah, yeah. Now you're at like what are you at now? Hundreds of millions or a billion
Yeah,
almost, or what?
yeah, we're actually I think 1.6 or 7 billion right
Wow,
now in our whole complex. Yeah, it's
1.6
crazy.
billion AUM.
Yeah,
Wow, you've grown a
yep,
lot since I last looked at that.
yep,
Wow,
yep. We're doing all right.
and
But hey, bull
the
market's great for everybody, right?
bull market's
So
great for everyone. Yeah, that's right.
yeah,
And you've
Except
been
the
at it for a
shorts.
while.
yeah,
Yeah,
exactly.
yeah.
So
So tell us a little bit about your background, Wes. How did you get involved in investing? I know you were involved in the Marines and you did some tours in Iraq.
yeah,
What was that like, and how did you kind of evolve into the financial world from there?
yeah. So I had always wanted to be in finance because I grew up on a cattle ranch basically, and I was broke, and I
Mm-hmm.
used to always have to go out in the fields and work. And I just would always ask my dad. I was like, "Hey, working sucks. I don't want to do this my whole life. Like, how do you get rich?" And he didn't know how to get rich. He was, he was working. He was like working as a hand on a ranch. He's like, "I don't know, man, but I think you should talk to Grandma Jenny." And I had this grandmother in California. She was like a huge Warren Buffett fan. And when I was a kid, I used to raise 4-H animals. And so there was a point, I don't even remember, I was like 10 or 11 or something like that. But I basically got like a few grand, which is a ton of money. I sold one of my steers.
Mm-hmm.
And then I just asked Grandma Jenny, and she got me hooked in the whole Warren Buffett, Ben Graham thing. So I was always into investing, even as like a kid.
Mm-hmm.
I played sports and everything. I was normal too. I wasn't a total weirdo, but I just loved it because I wanted to get rich, honestly,
Yeah.
and I didn't like doing manual labor. And then I ended up going to Wharton undergrad, and then there again, the same passion was I was like, hey, I just don't want to have to like do manual labor. I want to like just get rich, and finance seems like a great idea. And
Mm-hmm.
basically, what happened is I ended up liking the subject at like an intellectual level. Like I actually liked it. It wasn't just about the money.
Mm-hmm.
And at Penn there, I was basically a research assistant for all the faculty. And then into that and through that experience, they basically said, "Hey, you should do your PhD and be a professor because that's what you do all day is you just do research." I was like, "Really? You get paid to just sit around and think about stuff all day?" And they're like, "Yeah, that's what a professor does." I was like, "Awesome. How do I get into a PhD program?" They're so like,
Yeah.
"Well, get good grades, get good test scores, and apply to Chicago. We'll get you in." I was like, "Roger." And so that's what I did. I went right from undergrad into PhD. But
Okay.
then, and you guys probably don't know, but like Chicago Finance PhD program is like this ultra like hazing facility.
Hmm.
And I hadn't really done anything in the real world. I'd always been like trading and doing that kind of stuff.
Mm-hmm.
But I always wanted to do the service as well. So I basically took a sabbatical in 2002, or sorry, in the program 2002, left 2004 for 4 years, joined the service. Just figure, hey, I was young. I always wanted to
Mm-hmm.
join the service. If it never happened, and now it's never happening. And then so I did my time, came back, finished PhD, and then became a prof. Got seated by a billionaire, and the rest is history.
Wow.
So
Wow.
long story short, I didn't get into finance. I was always into finance. It's just the Marines and my side adventures were more, sabbaticals on the path to doing basically exactly what I do now. So
Yeah, yeah. You actually wrote a book about your experience in the Marines. I read that a while back. That was really interesting. I can't
Yep.
remember what was the title of that book again. I can't recall, but I
Yeah,
read it.
it's called Embedded.
That's right.
Actually, there's
Yeah.
a copy of it right there.
Yeah.
Yeah, and it was just, because I'd gone into that, like I was hook, line, and sinker on the Colin Powell. Holy shit, we're all gonna die. Here's this white powder, and I was
Yeah.
like, man, like, okay, that's cool. Like, let's do it. And then of
Yeah.
course, where I was there, and I was on embedded training teams where I like actually lived with Iraqis. I
Mm-hmm.
didn't work with the U.S. forces.
Mm-hmm.
It became very clear to me that, this is like, and now this is obvious, but wow, this is a total different culture, total different people, and this ain't ever gonna end well. Let's just get out of here and stop wasting resources. And
Yeah.
so that book was basically, I had to tell the story because my mind had changed 180 degrees, and I
Mm-hmm.
kind of came in with the same mentality I think a lot of people had, and I
Mm-hmm.
kind of learned the folly of how I thought. So I just wanted to make sure I
Mm-hmm.
wrote a book so other people could at least maybe hear my perspective and on me changing my mind. So
Yeah.
that's basically what that book's about. So
Yeah. No, thank you for your service, by the way. And yeah. So speaking of changing your mind at 180 degrees, I think I listened to an interview of you way back on Patrick O'Shaughnessy's podcast, maybe. And I think
yeah.
you had referenced like early days, you had bought some like stocks, some penny stocks, and lost a fortune.
Oh
You know,
yeah.
you were a speculator early on, and
Yeah.
mind how that
So
you changed 180 degrees, and you're not that type of that's not your investment
yeah.
philosophy today, right?
So you got it, man. And I've been at Interactive Brokers for I don't know, since '99, because that's when I got really started. Really is
Hmm.
probably like '98, and I was just a hardcore stock picker because I was coming in right at the internet bubble
Yeah.
when in many respects it was kind of like it is now. Like, markets go forever. Like, what are valuations? Who cares? And I was coming into that as a value person where my Bible was Ben Graham and Warren Buffett. And I was like,
Yeah.
this is insane. Like, why do people buy crazy shit with like 10 times sales? Like, the
Yeah.
things that you've done very successfully. That was just not part of my DNA. I was like what they call a cigar butt hunter, where I'd go find like penny stocks and micro caps, selling below cash value. And then I just got lucky, obviously, because like 2000, the market shit the bed. And then all of a sudden value goes on this epic rally. So I just killed it, man. I was basically a stock picker in small value from basically 98 all the way even to the service.
Hmm.
And then I just thought I was kind of like the man. And then 2008 happened. And I literally launched a hedge fund with you at Interactive Brokers, getting it probably set up in September 2008, like
Oh man.
when the whole thing went down.
Yeah.
And of course, it was one of my quant strategies because I thought like, hey, this quant stuff's a lot easier and more systematized. Let's do that as opposed to this pirate type of investing I used to do.
Yeah.
And of course, in September 2008, your buddy over there, Petterfee, I was short the Russell 2000, iShares fund, thinking like,
Yeah.
hey, because I was using it to be market neutral on my
Yeah.
strategy, and all of a sudden I got it called out from under me. And they're like, yeah, there
Oh
is
yeah.
no borrow. You can't borrow anything. And I'm like, well, I'm trying to run a market neutral hedge fund. They're like, yeah, but you can't short anymore. I'm like, well, it's an index fund. You can't short index funds? They're like, nope, can't do it anymore. And so basically I had to like, that
Oh
was a good
man.
lesson learning, like, back tests are a lot different than reality because a lot of times you just can't get leverage. You can't get short.
Yeah.
And long story short, I went back to stock picking and in December 2008. And I went back to my old ways of like super concentrated, load the truck up and, it worked for a while. And then I actually got caught in a fraud. And I
Oh.
had like a massive drawdown, man. Like, I don't even remember, like 60%. I got lucky and I got another thing that went up like 10x or something. But in the end, I lost all my hair, which, a long time ago. I still don't have it, as you can see. And after that, man, that was probably like 2010 or 11, maybe 2012. I just got religion. And I said, I am never picking a stock ever again. It's all going to
But you
be
still love
computer.
finance, so you need to stay involved, but not stock picking, right? It's
Yeah,
like
not stock picking. I love stock picking. I love
Yeah.
the game, but I was just like a drug addict, and
Yeah.
I pull. It was like an opportunity to pull the cord out.
Mm.
And I still am addicted to markets. I love finance investing, but everything we do is just systems based. If a computer ain't doing it, I'm not doing it.
Yeah.
So,
So Alpha Architect, that's your firm now. Yeah, it does
yep.
systems based investing themes a lot, and
Yeah, it's
um,
all computerized. You got it. Systems.
so I guess factor investing.
Yep.
That's sort of like something I've heard you describe. You and your
Yeah.
colleague describe a lot, and
Yeah,
you guys are on
Jack.
Twitter or on
Sure.
podcasts. And what is fact? I've understood it at times for like periods of time, but then like I
Yeah.
forget about it and I can't remember what it was. Maybe you
Yeah,
can
yeah,
explain it
yeah.
in like a 5-year-old kind of way so I can remember again what it is exactly. I
Yeah,
know it's
yeah.
a
So
systems
the
quant
best
based
way to
thing.
think about it is I like to tell people like the Moneyball example, right? So what is Moneyball for background? Well, back in old days, in early 2000s, like the Oakland A's, who are dead broke, are trying to fight against the New York Yankees, who got all the money in the world, all the scouts, all the analysts, all the 500 IQ people,
The
and
best
they're like,
stock picker.
man,
They have all the best stock pickers, basically.
yeah,
Yeah.
all the best stock pickers. And the Oakland A's say, you know what, this is crazy. Why don't we just look at data and see how data, predicts player outcomes? And then, if we know that there's certain characteristics of a player that in general lead to some outcome, and we know those outcomes are favorable for what we want, let's just use the computers to do it, save a lot of money, save a lot of brain damage, and see if it achieves like a similar outcome as if we did all the brain damage, right?
Hmm.
And so that's basically what factors are doing. All factors are doing is saying, hey, there's these stocks out there, and these
Hmm.
stocks all have different characteristics, and these characteristics are generally predictive of different risk return profiles that we may or may not like. And so that's all we're going to do. We're going to use those characteristics or sorts of or like multiple characteristics to try to identify baskets of our baseball players or stocks that we believe over time are going to be favorable, basically. So that's the
So
idea mechanically of what you're doing.
I'm curious how that works in practice a little bit, Wes. I mean, you
Sure.
mentioned earlier on that there's a big difference between kind of back testing and managing a portfolio.
Yeah.
So when you are essentially looking at all these data points to build out your portfolios, which are presumably
Yeah.
using historical data,
Yeah.
how do you kind of track that over time and kind of ensure that what the historical data has shown you carries going forward, and do you kind of need to adjust that in real time, and how does that kind of work?
Not really. So what you should do, so basically the way we use quant tools is to systematize good ideas to rip the human out of the picture, right? But they have to be good ideas. Like you can backtest anything and convince yourself of anything, but if you don't have a strategy that's based on first principles, where you can't identify what's the fundamental risk or why is there another idiot on the other side of the trade not doing it, no amount of back testing is going to help you out, right? So the things that we do, I would consider evergreen. And I think the data has borne these ideas out to be evergreen. And what are those core ideas? Well, the first one is buy cheap shit everyone hates. Value, right?
Yeah.
Why does that fundamentally work? Why does Ben Graham talking about that 100 years ago? Why is in every back test over the long haul in every market, every asset class on the planet Earth, why is it the case that when you buy assets that are just straight up cheap, do they tend to earn excess return? Well, it's pretty simple. One, they're generally fundamentally riskier, right? It's more risky to buy Kohl's than it is to buy Amazon, because Amazon is a way less risky business model relative to Kohl's, which is being destroyed. So what happens? Well, you get compensated for taking risk on firms that have, potential bankruptcy threat. The other component is mispricing. Like people throw the baby out with the bathwater, right? So, and it's just a systematic effect on average it works, where if you buy baskets of things that basically most people consider turds that are totally worthless, but you buy them at the right price with a margin of safety, on average expectations change, the world changes, competitive dynamics change, and you get this expectation difference where basically, oh, wow, maybe this firm wasn't as bad as we thought. It's not going to be completely bankrupt. It's just going to be a slow grower. But that change in valuation perception is how you make your money. That's basically the value trade, right? That's an evergreen thing. No one wants to go into Philly, buy boarded up, buildings in the ghetto, because that's just, I'd rather go own fancy stuff, right? So that'll always be a premium, because I don't think a lot of people want to hold that pain trade. And as people are learning, and they should have known if they knew the data, is being a value focused strategy, it can underperform if you're doing it not as a closet index, but you're actually buying baskets of cheap stocks like we do. You can underperform for 5 years without even thinking. That's happened 10 times in the past 100 years. And so this idea like, oh my God, value stocks underperform the index. Well, no shit. Have you ever looked at value stocks? But that's also why they work, right? They're very difficult to hold those portfolios. And it's very hard for big institutions to do something like that because they'll get fired, right? The other great trade that I also find evergreen is the exact opposite, momentum, right? Buy shiny rocks as long as they're shining. And so all you do with momentum is you just buy winners, right? Stocks that are doing relative well to other securities. And as long as they maintain that status, keep owning them. Otherwise, get out of the way. You never want to own a low momentum security, especially like a growth stock or something that's really expensive. And why does that work? Well, 2 reasons. One, momentum portfolios are insanely volatile and have gut-wrenching drawdowns. So there's obviously some fundamental risk there that stinks. It's not like a T-bill. And then the other thing is there's a big element of mispricing. And there's a lot of people argue the different reasons for it. But essentially, you see most of the research, I think, probably points to actually an underreaction to positive news, right? Price pressure tells you something about a firm, and nobody wants to be a bag holder and buy at the 52-week high. They're selling, right? So there's all these weird dynamics in the marketplace where people just cannot handle owning things that are at the quote unquote peak. And so you always have like this natural kind of underreaction to what the price is actually telling you. And the reality is it's probably doing that for a reason. There's also some arguments about reflexivity too. We're like, Elon, your guy's boy, Elon could go raise capital to fund any project in the world without even blinking and sell like a little bit of stock. Exxon would have to go get cash with the cost of capital of 20% probably to get anything done, right? So by having good price action in your stock and a lot of like mojo in your world, it actually can reflexively actually improve your fundamentals. And a lot of people underreact to that kind of hidden benefit of actually having like a rip in stock price and a huge valuation, because you basically have cheap cost of capital relative to all your competitors. And that can help you fund projects way cheaper than Joe Blow down the street. So anyways, buy cheap stuff and buy winners. Those are kind of evergreen ideas, and we back test them, just to ascertain, do we think we're in the right direction? But I don't need to back test things anymore. Like I've already been doing that for 20 years. I just focus on first principles, and will this work 50 years from now? Because I believe in it fundamentally. Great, I'm gonna keep doing it. That's how we kind of think about it.
Are those 2 principles ever in odds, or will they tell you? Presumably, they would tell you to buy different securities. So, like,
Totally.
for example, like a value play, wouldn't be like a GameStop, but a GameStop would be a momentum play. So, are those in different, kind of portfolios that you would manage, or how do you?
Not only that, they're different religions, right? And that's why I think they work so well as counterparties, where, as if you came out of the valuation world and if you come out like Warren Buffett fundamental world, the mention of technicals or stock price action literally will get you thrown out of the club, right? They think you're a devil worshiper. And then if you go over to the other religion of like technicals, trend followers, price action people, they'll tell you straight up, like, you pay attention to fundamentals. Like, who cares? That doesn't define supply demand. The price does. And so you have these 2 religions, and it took me a long time to get access and think and embrace the momentum religion. But I think the key benefit of those two concepts and the reason they have two religions behind them is because they're both pretty interesting in their own different ways. So I'm just a huge fan of doing both, right? Like I'm a huge value person, and I think it works because of extra risk and mispricing. I'm a huge momentum person for the same exact reason. And I like to combine them because I don't like to sit around and wait for 10 years underperforming the market in one religion. Like if you have two edged bets and they naturally yin and yang, why not, do a 50-50 on them? Because presumably it can kind of smooth you out, along the way is the basic concept.
Interesting. Yeah. And do you have, is there times in the market where you feel like, it's almost reminds me of like risk on or risk off trade that they talk about in the media. Like risk on is like go to the momentum plays, risk off, go to the value plays. Is that sort of in line with what you're doing in a way? Or?
Not really. So I'm all about strategically holding the exposures. If I'm going to hold stocks, I want to hold some value. I want to hold some momentum. I want to hold them globally. But then the next question is, well, there's two questions. Well, what about factor timing? Which is, well, instead of just holding them strategically, roughly 50-50, why not, if something in the world says do more momentum, why don't you shift more towards momentum versus value? And so we've obviously studied everything on the planet Earth there. There's a million papers on it. The basic summary on all those papers, if you don't pay attention to people selling you crap and just pay attention to like academic research and robustness, I think the only thing that actually probably works empirically is relative strength, momentum, basically. So if value is generally in a strong, like the value factors in a strong relative position to momentum, in general, on average, it tends to work. It continues to work, right? So that's great. The problem is the following. I have very high confidence that if I pool value stuff with momentum stuff, they're going to be diversification benefits because they're just different religions, right? The minute you start factor timing, you're kind of throwing away the bird in the bush for potentially two in the hand, right? Because if I start timing and I'm like, well, I'll drop momentum, I just want to go all in value right now, you just lost your diversification benefit that is probably going to be there. So for me, even though I know empirically that doing relative strength and kind of moving between value and momentum is actually probably a decent idea if you figure out how to manage the taxes, the fees, and all that good stuff. The barrier is so high because I kind of just want to be a static holder of both positions because I don't want to give up the diversification benefit. But that's a trade-off and something that people, I think, could argue about. But yeah. So that's factor timing. And then you're also alluding to beta timing, potentially like timing the market component. And, we use trend for that. That's the only thing I believe in on that front. Like just trying to like, when do I actually want to be invested in stocks versus not, whether it's value, momentum, Tesla, or anything in between. That's another decision, but the decision to be in equity risk is something that, we like trend following as a tool for that, but I like buy and hold too. It's just painful.
It is painful. I
Yeah,
think
yeah,
we experience pain like twice
crazy.
as much on the way down than the euphoria of when it's going up the same amount or something. I don't know. There's been studies on that. Yeah.
Well, and that's why the best investors are like someone like yourself, where you have so much conviction in what you know about, and you're so not able to get influenced by noise. You can just stick to something, even though inevitably it's going to have 50% drawdowns, maybe multiple ones along the way. It's like Bitcoin holders, right? Like unless you're just wired different or you're a true blue hodl type, you would not have held in like 2012, 13 to today, right? Because you have endured so many insane vol drawdowns. You've made so much money. Like an idiot like me would have sold it like, well, it's a 3X, I'm out. But of course, I would have missed the 1000X, just like on Tesla, right? Like if I would have bought Tesla when you told me, which I didn't because I'm an idiot, I would have been out of that thing on the first double because I'd have been like, God, I love Emmett. I appreciate it. I'm going to send him a Christmas gift. He's crazy, dude. I'm out of this trade,
Yeah,
man. I'm
yeah,
moving on. But you have to have the conviction, or you have to
yeah,
have a system that would say, no, it's got momentum. Keep owning it,
yeah,
right?
yeah,
Like that's why I use systems now, man. I just can't be
yeah,
thinking. I'm
yeah.
too much of an idiot
Takes
to
the
do that.
emotion out of it and keeps it much
Yes.
more quantitative or
Yeah,
factorial, I guess. Yeah,
rules. Yeah, keep rules in place. Make sure you want to spend a lot of time building your systems, building the rules to make sure they're evergreen. They're never going to get you into trouble. But once you
mhm,
have those rules, you almost just tie your hands behind your back. It's just like, at the top of this, like I don't even know what the market's doing. Like I
yeah,
generally hear because I'm on Twitter,
yeah,
it's doing great. Oh, it's crapping.
yeah,
But it just doesn't, it's irrelevant to me. I don't care.
yeah, yeah.
I'm in for the
Interesting.
20-year game. So
Yeah. Now, sorry, Matt, you were going to say something?
Yeah, no, yeah, I was just going to say, it seems like the kind of emotional part of it is not only, you as like an individual investor, but you're managing on behalf of a lot of other investors.
yeah.
So I'd imagine a big part of kind of your job and the reason that you choose the strategies that you choose is to kind of get investor buy-in into what you're doing and why. So how
Yeah.
important is that kind of communication aspect of what you're
So
doing? And
yeah, it's our firm mission, right? Our firm mission is to empower investors through education, period. Because we do concentrated factor portfolios where every PhD on the planet can go do every back test in the world, and it's baked in the cake. At least historically, these things work. What's also baked in the cake? Massive, unbelievable career risk. You will outperform, underperform, get fired probably every quarter. And anyone with half a brain managing money on behalf of someone else would never do what we do, right? So
Mhm.
we inverted the problem where we said, hey, we're not going to be a distribution shop where a lot of people say, oh, products are sold, not bought, i.e., Joe or Susie's jamming it down grandma's throat. I
Yeah.
don't like that. That's not my culture. And I've always been like educator. I always been into it. So that's what we inverted. We said, you know what? We're going to empower investors through education. We're going to do these insane ass strategies that no one with half a brain would actually do if they were in the asset management business. But they're the strategies I like. I put all my money into them. And we're just going to be insanely transparent and help people understand the research, the data, and the evidence. And hey, if you want to buy our stuff, great. If not, also great. I don't really care, right? So our
Mhm.
products are bought, not sold, and we just provide the background, the transparency, the process, because we basically in the end we need behavioral issues to work in our favor. And one of the big behavioral issues is endowment effect, right? So endowment effect is this idea that if Matt hires Wes and Wes
Mhm.
underperforms S&P, you can be like, Wes is an idiot. Let's go hire Emmett, right? But if I go to Matt and I say, Matt, you're not buying me. I'm going to force you to read one of my books, and you're going to back brief me exactly on this process and why you think it's such a great idea. Because I'm telling you right now, I think it's stupid, and you'll probably kick out of it in a quarter. But after you build endowment, you're like, well, actually, no, I love this strategy. It makes sense to me. This is my decision to invest in this crazy value thing or whatever. Now that you have endowment effect on it and your ego's tied to that investment, you're emotionally into it, it's way harder when it underperforms and everyone tells you're an idiot to do XYZ to blame Wes, because it's actually you, right? And once people have endowment effect on a decision, it's a very powerful way to keep people committed, where it's easy if you outsource it. So we use behavioral tricks to basically help people be better too and be more disciplined, essentially.
Mhm.
yeah, and I'm curious. Like I was listening to you on the Rational Reminder podcast you did a little while back, and you gave a great example there of like what sounded like a very kind of like quant heavy like finance PhD type, which I've got a background in finance, and I didn't exactly follow all the individual strategies that you were just kind of rattling
Yeah.
off. So yeah, I'm curious how do you kind of simplify these really complex trading strategies or
Yeah.
portfolio management strategies to kind of everyday investors or somewhat sophisticated investors, but
Yeah.
who presumably don't have a finance PhD.
Yeah, I mean, it's pretty simple. Like value, the value trade, we say, hey, we're going to try to buy the cheapest, highest quality stocks. And they're going to outperform and underperform, back and forth. But fundamentally, all we want to do is we want to focus on businesses that are cheaper relative to the entire universe of other stocks out there. And then amongst the cheapest dirt balls, we're going to find the highest quality ones, right? Because let's say you got stock A, has a 10 PE, stock B has a 10 PE, stock A is making money, paying down debt, buying back stock B is losing their ass. Hey, let's buy stock A. They're equally cheap, but one is high quality. That's all we're doing there, right? And for anyone who's like a business owner or anything like that, like, hey, do you want to buy the firm that is really cheap and makes money, has good fundamentals? Or do you want to buy like the really expensive stock that doesn't make any money and has shitty fundamentals? And yeah, maybe the market won't agree with us, but over 20 years, does this seem like a process that makes sense to you as a business owner? And most people are like, yeah, duh, of course. Like, like if I were to go buy Susie's, lawnmower business down the street, I would ask Susie, hey, what's the price of your business? And I'd say, okay, that seems pretty cheap. And I'd say, hey, Susie, are you making money? Do you have a ton of debt? Like, do you have like do you have acid buried in your backyard that's about to burn everything up? Like, is this a scam? Oh, no, this is actually high quality. Great. I'll be a business buyer, right? I don't care what the market says. I'm just buying a business. That's value. Like most people, they don't need much coaching there. And then on momentum, it's just, people around people. Like this is a strategy that basically buys shiny rocks because shiny rocks tend to get perceived as being shinier down the road. All we do is systematically buy shiny rocks and hold them because we know on average, shiny rocks tend to get shinier. And most people get that. They're like, oh yeah, like I know, because I'm a bag holder because I should have bought Bitcoin 2 years ago, 1 year. There's always all these examples where like momentum is an obvious thing to people. Like buy the things that are moving relative to all other things because they tend to keep on moving. So that's momentum. And most people, I think, fundamentally, they kind of understand. It's because you see that everywhere in life. You see that in nature, right? You see things that mean revert. You see things that are convex and don't mean revert. That's values mean reversion. Things tend to revert to the average. Momentum is the opposite. Some things in life, not many, are convex, right? They just they're like the Teslas of the world. Like they don't mean revert. They actually, they continue. They have momentum. And so I just don't know which state of the world you're going to be in any pile, but I do believe in mean reversion and continuation. So I just hold both of them. And I think most people, they're like, it makes sense.
Yeah. Now, your clients, your clients tend to be a lot of high net worth investors or family offices and such, right? So I would imagine, and I think you have used the term like ultra high net worth. Like a lot of your clients are pretty ultra high net worth. So you got to think tax. Taxes are a big part of the conversation. What are some things you can talk? A lot of our audience, is based in the U.S. and has tax, concerns or could benefit from understanding some basic tax idea principles. Like what are the top things you'd suggest for folks that are sort of high net worth and trying to figure out how to manage their tax situation better?
You got it. So I'll even go deeper than that and step further back. It has nothing to do with being ultra high net worth or being broke, which I've been most of my life. The same principles apply to every investment. We call it the facts, right? What matters to investing besides the actual investment? It's the facts. F stands for fees. Fees are something you directly control. All else equal, higher, worse, lower, better. No kidding. The second one is access, which refers to liquidity, right? All else equal, never, ever give up liquidity because that liquidity option, a lot of times people give that up in private investments or what have you. The reason you don't want to give up liquidity is liquidity is most valuable when opportunities are the highest. And that's usually when you can't get access to your liquidity. So all else equal, unless an investment is just extremely compelling, never give up liquidity, because that's usually when if you have liquidity, you have the option to go and buy on the things that are like really cheap and distressed and blown up, right? The other one is C, complexity. Avoid it like the plague, right? The more complex, on average, the worst, right? And the barrier to adding complexity should always be extremely high, mainly because it's usually clouded behind extremely sophisticated marketing people. And humans naturally think something's more complex, it must be better. But that's just not true empirically. And then T, well, I'll go to facts, right? I'll do S. S is search, which is in reference to due diligence and brain damage. Minimize it. T in facts, taxes is, so all that other stuff you want to consider. Taxes is the biggest one, as you know, because Uncle Sam has a 50% performance fee on everything you do. And everyone, like, we're going to go argue about Vanguard because it's 5 bips versus 4 bips. Dude, the US government is 5,000 bips or 500 bips, right?
Yeah,
Like
5,000.
Yeah, it's 5,000 bips. We're in a different zip code, man. If you're not thinking about tax management, you're wrong. Like you're just a terrible investor. Like I don't even want to talk to you. Because you lost the whole point. Like there's no point arguing over investing. Well, my alpha is bigger than your alpha because I got 1% alpha. But if your strategy requires me to give half of it back to the government every year, it's a non-starter, right? So as far as like tax, and you know a lot of this stuff, I mean, the richer you get, the sad part is the more access you have to doing crazy wacko tax things, right? So when you're really broke, taxes, well, who cares? You're not making any money, so you don't have to pay taxes. And then when you're really, really rich and you're like a billionaire, you can go hire every CPA, every PhD, every lawyer on the planet, and you have access to really cool stuff, insurance and all this other, like, it's crazy. And if you're kind of you're earning it, you're in the middle, you're that middle class, upper middle class, that doctor, that lawyer, that engineer, you're just screwed because you probably got a lot of W-2 income. And I always tell people, hey, get out of W-2 income if you can, because being an entrepreneur, I know it's a lot riskier, but remember, now you're building something that is compound long-term capital gain, where if you're working W-2, you're basically making half of that every year and none of it's capital gain, right? So all else equal, get into capital gain, get out of W-2 if you can swing. The other thing is make sure you use the appropriate wrappers, right? So ETFs, as you know, are essentially an IRA for everybody, because ETFs, once you buy them, within the ETF, it's like a laundromat for capital gains. So as long as you buy an ETF and just hold it forever, you can compound essentially tax-free until you sell it way down the route. So it's like an IRA kind of. So make sure you have the right wrapper on your.
That's a huge benefit. I think that's very underrated and under talked about. Like if you own a mutual fund or in a hedge fund interest like our fund or whatever, then you have to pay taxes every year on it. But an ETF, like an actively managed ETF, if you participate in that, you could you not have to pay taxes, like you said,
don't
as
have
an
to
IRA
distribute
for 30 years.
Exactly.
Hold it.
Well, in this year, it's going to be there's going to be a lot of nasty emails and here at the end of the year, because what happened in growth funds, especially mutual fund, is they killed it first 6 months of the year, banked tons of capital gains. A lot of people have gotten into these funds just the last 3 or 4 months, and now they bombed out. So what's going to happen is at the end of this year, a lot of people that just don't know what they're doing, they bought into these mutual funds. They're going to distribute massive capital gains, and they're going to have lost money. So can you imagine at the end of this year, you put $100 in something, it's now worth 80, and then they say, oh yeah, you owe $20 in taxes. That's what's literally going to happen to a ton of people that invested in growth mutual funds and a lot of other things at the end of this year. They probably don't know that yet, but it's going to happen. Whereas an ETF wrapper, it's just that doesn't happen because it democratizes tax and it pushes it out to the individual holder. So now everyone can make their own tax decisions. You don't accidentally buy into tax liability. I mean, mutual funds are not terrible for everything, but if you're doing stocks, they're horrific to own stocks inside a mutual fund. You should certainly consider an ETF wrapper, I would say.
Yeah.
Um,
So
what are some
we
other?
talk,
Yeah. Go ahead.
Puerto Rico, like speaking of tax, we'll go back to the ETF thing in
Yeah.
a second. But Puerto Rico, that's something you've pitched me on personally a couple times.
Yeah.
And to come down. You moved down there yourself recently, right? And
Yeah.
what's there's a huge benefit on that. I'm not sure everyone is
Yeah.
aware
Yeah.
of
Yeah.
it.
So,
What's that about?
I'll give you the nickel tour on it. So I think it's the greatest thing ever. Mainly because I just love Puerto Rico. I love the environment. I love the adventure. I love the people. And frankly, I'd probably do this without the tax deal, but the tax deal is also absurd. So it's called Act 60. Historically, it was referred to Act 20 and Act 22. But essentially, there's two components that are most relevant to most people like us. There's the individual component, and then there's the export services component. I'll explain each of these. So the individual component is essentially a 0% capital gain benefit is the easiest way to think about it. Okay. So if you come down and be a bona fide resident of PR, so you have to live here for at least 6 months and actually like have your family and kids and like it's your real house. It's not just like a vacation hut. Like, kidding, live in Puerto Rico. Under Act 60, under the Individual Act, you basically pay 0 capital gains. So as you can imagine, there are herds of crypto people down here. Like literally 80% of people I meet, I'm like the TradFi guy. They think I'm a loser because they're all like, these people have been down here for like 5-6 years and have massive gains in crypto, and they're paying 0 tax on it because of Act 60. Now, but what a lot of people get confused on, though, just to not get people too excited, is legacy capital gains are stuck, right? So let's say you put $1 million in something, you get lucky, it goes to 100 million. Holy cow, that's amazing, right? Yeah. Unfortunately, if you move to Puerto Rico tomorrow and sell that position, you still have to pay all your U.S. tax, just like you never moved down there. So
even if you sell that position a year later after you move there?
Yeah. Yep. Okay. However, one exception to that is if you live here for 10 years, now all of that capital gain will be sourced to Puerto Rico and you aren't subject to U.S. tax. You got to pay like 5% Puerto Rico tax or whatever. And that's for public assets, right? So you can't be a billionaire, come down here for a day, turn around and sell it and get rid of all your tax. You'd have to live here for 10 years. This is for public assets. For private assets, they do it by time weighting. So let's say you bought your business, or you started your business 5 years ago, you go live in Puerto Rico for 3 years, you sell it. Well, you got 8 years total on the business. 3/8 of it would be 0 tax. 5/8 would be normal capital gains. And that's basically the Individual Act. So it's a massive capital gain benefit, and it's extremely good for people that are traders, investors, crypto people who've got long horizon or are willing to commit to the island. It's amazing, right? You don't have to pay any tax. It's great. The other one that's also incredible is the Export Services Act. So if you come down here as an entrepreneur or you move your business down here, your corporate tax is 4% and your distribution to a bona fide PR resident is 0. So essentially your income tax is 4%. So if you move down here, let's say you make $1 million a year in your business and it's something that you can export because you're not making widgets, but you're selling advice, consulting, whatever. You $1 million, you live in California. Well, you only get 500 of it. Congratulations. You're an idiot. Yeah. If you move to Puerto Rico, you get 960 of it. Doing the same thing. You have to live in Puerto Rico and support down here. So the Export Services Act is crazy. And the entire Puerto Rico thing is crazy, frankly. However, and a lot of people know this, especially like I'm married, I got kids. And so remember, you want to avoid 50% drawdowns, i.e. get divorced. So you obviously, if you're going to do something like Puerto Rico, it's really important, obviously, to make sure that the family's on board. everyone actually likes it. Because if you just do it for money and people hate it, your life sucks. So who cares how much money you got? But
Yeah.
if you got the family on board and they like it anyways, and you consider it like, hey, I'm doubling my income basically. It's pretty compelling opportunity, I think, for a lot of people, especially young people that don't have as many legacy connections to their community or whatever. That's a really good one. If you're, it's a little bit adventurous though.
Yeah, and there's some talk that might not be available for a long time, but if you get in while it's still available, you're kind of grandfathered in. But at some point, they might put a stop on allowing you
exactly. Yep. So you get grandfathered in, so it's something you can't just wait around on because and technically they can change it year to year, or they could just stop the program. But I think it was Walmart won like a Supreme Court lawsuit where they tried to retroactively like pull they're called like the decree benefits away, and they lost. So, I mean, there's pretty, I would say, well, the strongest, precedents you can get, the Supreme Court, that once you get locked in on your deal at the time that you cut with the Puerto Rican government, that's your deal for the, as long as you want to keep doing it. Yeah.
Yeah. Okay. Interesting.
Yep.
Yeah, no, that's really helpful. I think a lot of our listeners will appreciate hearing more about this.
Yeah, I mean, there's huge community, just to reiterate, of like, if you're into crypto assets, I mean, there's a massive community for that, huge community of investors and traders. So it's not like you'd come down here and just like hang out by yourself on the beach. Like there's huge communities of people that are really in to a lot of like cutting edge finance. So you're not like just going to a random island.
What's the nice area? One of the nice areas is like Dorado or something like that. Is that right? Is that the name of it?
Yeah. So there's really, there's a lot of nice areas. There's Dorado. That's what I always tell people. That's where all the private equity hedge fund people live that charge 2 and 20. And it's because it's so expensive, and it's like Beverly Hills of Puerto Rico.
Oh, cool.
And then where I live down in Palmas del Mar, which I think it's just as nice, if not nicer than Dorado. But this is where like ETF managers live because, we charge like 50 basis points. So it's just the cost of living, and it's just a magnitude less.
Yeah.
And I'm a value guy, probably like Matt is, or used to be. So, I feel like it's just a way better value. Dorado is just a little bit above my pay grade. But people love it. It is amazing. It's just very expensive.
So speaking of the ETF stuff, I mean, that's like, I would think that's like when I ever have questions about ETF structure or setup or whatever, like, even when I worked in prime brokerage sales and I worked with a lot of startup ETFs trying to do business with Interactive Brokers on an execution basis or whatnot, like you were the go-to guy, almost like I could contact and ask for opinions about how this works or how that works. An agent, what is a transfer agent, or all these different terms, what they do. Can you describe the ETF structure and setup process? Like I'm 5 years old, perhaps, like, because a lot of our listeners, they might be interested in how that works as well.
Yeah. So, where to start? So this, the background, we've been doing it for 10 years, and now we just launched a platform called ETF Architect. It's been around for like 3 years now, where the mission of that platform is to figure out how do we rip out the cost, rip out all the stuff that sucks about coming to the ETF market, and make it more accessible for people, basically, right? So that's the mission of what we're trying to achieve. And I just want to give that context because like starting an ETF has always been a complete nightmare times 10. And now we've made it like a nightmare times 2. Like it's still a big deal, right? Because essentially, to summarize, what you got to do is you're basically having an IPO, right? So you can only imagine like, hey, I'm going to go launch Tesla in the public markets, i.e. I got to have an IPO. Well, guess what? That's what an ETF is doing basically, right? You're going to come to market with a public security and have an IPO to launch, right? So that means there is thousands of pages of legal crap that you need to file with the SEC to get approved. All the procedures, all the stuff that, great to protect the interest of investors. It's just a massive lawyer fest, right? That's all up front. And once you get that done, you launch your ETF. And then really the ETF game, now when you launch an ETF, you're going to have a ticker that is obviously publicly accessible of any
Mhm.
broker in the world that doesn't block it, right? So
Mhm.
sometimes the banks will block tickers so you can go behind the scenes and pay them off, like Merrill, UB, the big,
Yeah.
as you would think, they're called wirehouses.
Yeah.
They're not open architecture, but most people in your audience, like, Robinhood, Schwab, Interactive Brokers, TD, Fidelity, they're all open architecture brokers. So when you have
Mhm.
an ETF, you're basically accessible to the world. So your job as an ETF operator, or sorry, as an ETF sponsor, like the person that's the portfolio manager, is basically convince the world that you know what you're doing and sell
Mhm.
this thing, right?
Mhm.
That's really the job, because now you're just a ticker and anyone can learn about you on CNBC, on a podcast, or what have you, and be like, oh, Emmett and Matt, they're really interesting. What's their ticker? Let's just say it's Matt is the ticker.
Mhm.
Let's type in
Mhm.
Matt. Boom. I just bought 1,000 shares. I'm a proud owner, right? On our side, we obviously have a lot of ongoing logistics, because you got to run basically regulatory compliance, the audit, the tax, the fund administration, accounting, and all the actual nuts and bolts of the portfolio management. And
Mhm.
probably, I would think the most interesting thing to your audience would just be walking through kind of like the tax element of an ETF. And I'll try to explain that to a 5-year-old. So
Okay.
essentially what's different about ETF and why they have this huge tax benefit is basically it's through how they're structured. So if you were to buy or sell a security in a hedge fund, a mutual fund, a separately managed account, it's like, as you would expect, when you buy something with a gain, you have a capital gain, you got to pay tax on it, right?
Mhm.
That sucks. Well,
Yeah.
what about an ETF? Well, same thing. If an ETF were to actually sell a security at a gain in the ETF, it's the same thing. We would have to distribute a capital gain. But that's not what an ETF does. ETFs basically trade and exchange securities in kind through baskets. What the heck does that mean? Well, let's take a very simple example. Let's say you have an ETF with one share, your guy's favorite share, Tesla.
Mhm.
Okay, we buy Tesla. We start the ETF. We buy one share of Tesla at $1.
Mhm.
A year from now, it goes to 100. And for whatever reason, we don't want to be a Tesla owner. We want to be, a value investor. So we're going to go buy like Exxon or something, right?
Mhm.
And we're like, well, we don't want to sell Tesla because we got to pay a huge capital gain. So what the ETF will do is we will set up what they call a custom redemption basket, where we'll take that share of Tesla, which is worth $100, and we'll push it out to what they call an authorized participant, which is basically a banker, broker, dealer, and they receive this custom redemption basket of $100 of Tesla.
Mhm.
Simultaneous to that, because we've delivered out $100 of value from the ETF, now it has zero. You can't do that. We will simultaneously do a creation unit with the AP for $100 in cash, right? So
Mhm.
the fund is net the same, but we've custom redeemed out the Tesla security, which is a non-taxable transaction.
Hmm.
And the market makers, or the APs, or the broker dealer, whatever name you want to call them, they don't have the same tax as us. They operate under what they call 475 mark to market election. So when they
Mhm.
receive securities, they're mark to market. So it doesn't matter they receive the low basis stock, because they're like, I don't care. It's worth 100 to me when I get it. Right.
Yeah.
So they're no worse off. The fund's way better off because they just dumped out $100 stock without any tax consequence. And now that $100 of cash in the fund, we can turn around and go buy Exxon, and we reset the basis to 100. So
Mhm.
essentially, the ETF structure is a laundromat for capital gains liabilities, right?
Mm.
It's you never have to distribute capital gains because we can always trade through the custom create redemption process.
Yeah.
Now, to be clear, though, that's obviously awesome, but it doesn't mean you're dodging tax, right? Because if you
Mhm.
bought the ETF at 1 and the NAV is only Tesla, now it's at 100. If you as the owner of the ETF were to sell it at 100, you have to pay the capital gains. But the whole trick of an ETF is you just buy it and never sell it, and you let the activity of the trading activity go inside the ETF, because they're not going to generate capital gains. So all an
Yeah.
ETF is basically, like I said, it's like a Roth IRA. Basically, you put
Yeah.
money in this thing, and it's more like a traditional IRA.
Traditional.
Sorry.
Yeah.
Yeah, where you put it in, it compounds, but then when you want to take it out, you got to pay tax, but at least you get a compound tax free. So it's pretty
Yeah.
awesome. Yeah.
Yeah. No, that's great. That's amazing. And I think ETFs have really taken over from mutual funds as like the more popular way of investing. I mean, it seems
Yeah.
to be the future. We're moving towards more
Yes.
ETFs versus mutual
Well,
funds, right?
100%. And I'll tell you why, because we're in the middle of like making that happen. Some other really cool kind of technologies and capabilities out there that your audience should be aware of is that basically mutual funds, hedge funds, and SMA, separately managed accounts, like pools of securities in a brokerage account, can be
Mhm.
converted into an ETF tax free.
Wow.
So yeah, so we're in the
Man, we better
middle of
take note of
actually,
this.
yeah,
Yeah.
we're in the middle of doing that right now. So we've already done a hedge fund conversion into an ETF
Wow.
tax free. We're in the middle of doing a few mutual funds tax free.
Wow.
And then we're also in discussions on doing like some art like advisors where they have 10 clients that all got these, low basis securities. You
Mhm.
can contribute those into an ETF. So
Yeah.
when you say like, well, mutual funds don't seem like, why would you ever do that? Well, what's going on right now is a lot of mutual funds, because we finally figured out how to do these conversions tax free. They're like, well, yeah, let's just convert the mutual fund into an ETF. And now we're back in business. We got an
Yeah.
ETF ticker, we got all the assets, but now
Yeah.
we can manage things without having tax issues.
Yeah. Less
So
friction
that's
for investors to buy and sell it too, versus having to
yeah.
sign mutual fund
Yep,
agreements or whatever.
exactly. It's easy. You
Yeah.
go to your brokerage account, type it in, done.
Yeah.
Um, Now the problem with the conversions, like, just so you know, like the brain damage, we should probably disclose that. But like to launch an ETF is like 50K startup minimum, and
Yeah.
like annual cost is like, just to be conservative, probably 225, 250K a year, right? So
Mhm.
it's a pretty serious endeavor.
Commitment.
It's
Yeah.
not, yeah. And then the conversions are even worse. They're like, because you usually have to have a proxy. That's like an additional 100 or 200K. So to do a conversion is like a 250K
Yeah.
startup, and then a
Wow.
minimum probably like 250K a year run rate. You can
Yeah.
sometimes get it lower, and we're working on that. But so doing these things, it's not something like you got $1 million. Oh, I'll turn my, like it's you got to be pretty serious about it. But if you've
Yeah.
got like 25, 50 mil, you think you
Mhm.
can rally up, then the numbers do start making sense. But
Mhm.
unfortunately, we haven't made launching ETFs free yet. We're trying,
Yeah.
but too many lawyers involved.
There's only gonna be so many tickers available too. I mean, eventually we'll run
I
out of
know,
four-letter
I know. We've
combinations.
got a bunch. Well, you remember the old internet days where
Yeah.
when people would squat, and it was like $1, so people would just go
Yeah.
get like thousands of domains.
Yeah.
It's even worse in ETF industry. There is
Oh
no
my
cost
gosh.
to reserve. You just have to have a relationship with the exchange. And so
Yeah.
what's happened is like a lot of us who've been around, we have like literally like hundreds of tickers that we've kind of locked in. But now obviously there was a tragedy of the commons where like everyone's like, oh, there's no cost to reserve. Let's just go start reserving. So right now, like if you can even imagine it, it's almost 100% going to be reserved. And then you got to go haggle and horse trade,
Mm,
with people like, well, I'll give up my good ticker if you release it off reserve. But
yeah.
yeah, so all
That's funny.
tickers, there's a lot of good tickers out there. None of them
Yeah.
are available, but you have to do
Yeah.
like behind the scenes, like horse trading
Negotiate.
and
Yeah.
yeah, drug deals to get it done, basically.
Crazy.
Um,
Crazy.
so
So
if you,
one
yeah,
one thing about these ETFs too, though, real quick, is you can't really do this. Like you can do long, short, actively managed ETFs, or even systematic, actively,
yep,
long, short ETFs. I'm sure, but and I have seen a couple ETFs where they do like a covered call strategy on top of an
yep,
index or something. But
yeah,
it seems like the type of things Matt and I do in our fund, where we're like buying long-term call options on certain
yeah.
stocks or whatever, that type of thing might be pretty difficult to reproduce in an ETF, I would imagine.
Yeah, so what I would say is ETF innovation is hot right now, and the
Mhm.
barriers to being able to do these sort of things are slowly getting, broken. But it's certainly the case if you're doing heavy derivatives and a lot of trading activity, it's just not going to be appropriate yet for the ETF wrapper. It's
Mhm.
getting there. Like
Yeah.
stocks, brain dead.
Yeah.
Bonds, brain dead. Fund of funds, tactical, easy. Some
Mhm.
derivatives, like you said, cover call strategies, or derivatives that are small percentages of the NAV, doable. Futures,
Yeah.
doable.
Yeah.
But the more advanced things, you're right. It's just not there yet, but it's slowly moving in that direction. Because even
Yeah.
on our platform, we just see like innovation, in real time because we're on the front of launching these things.
Yeah.
Of people keep coming to market with like more and uniquer things. So it's
Sure.
it'll get there in probably 5-10 years, I imagine, for sure.
Yeah. 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 Great. I mean, you've been a real wealth of information on all this stuff. Before we let you go, I wanted to just ask you, just I guess on a personal level, what do you think about Tesla, the company, or Tesla as a stock? I mean, do you think? I
Yeah,
know you've been skeptical in the past. Most people have been skeptical in the past of the stock,
sure.
especially, and
Yeah.
you might still be. But I mean, do you think it's
So,
most
dude,
people that
I
work with
am
love
the
Tesla? So
biggest Elon Musk fan on the planet. I
okay,
love that guy. Honestly, I think he's
yeah,
straight up genius, and
yeah,
he adds so much value to society. Like, in my opinion, like with just his ideas and his willingness to not deal with all the government and just be like, "You guys are idiots. I'm just gonna like find wins." I love
yeah,
it. Right.
yeah,
I would literally like kiss the guy's feet if he was here. I just feel like he's added so much value to society and will continue to do so. And he just gives so much hope and inspiration. Like I honestly love the guy.
mhm,
Now that said, you can love a guy, you can love a company, but not like the stock price, right? To me, it's just I mean, if it's got great momentum, I'm a buyer, right? And
yeah,
and I had to write a damn book on momentum to convince myself to be a momentum investor. And I know I need to do it, even though I don't like it, right?
yeah,
But I'm a value guy, okay? So when I look at Tesla, it seems like it's so expensive,
it
which
seems, yeah,
it
yeah,
seems, and I just cannot put the blocks together to
yeah,
have it make sense of risk reward. But that doesn't mean I know anything about it. And honestly, I could be convinced other ways. And the best example is I remember the greatest short, well, the worst short call ever, the best write up ever was on Amazon. It was
hmm
probably like I think it was like 2005 or 2006. I actually did it. I made a little money just on dumb luck. But the
yeah,
short thesis was, dude, like Amazon is a retailer. You got Walmart, you got all these other guys. Like in the mean reversion steady state, it's like whatever 2-3% margin business, and it sucks. And
hmm
yet the valuation on this damn thing assumes it's going to take over every retailer on the planet. And of course, the one little rebuttal in there is like, well, they have this thing called AWS. And at the time, I was like, well, what the fuck's AWS? Like, I don't even know what that is. And so but that's what got people, right? It was this
yeah,
epic short thesis that made total sense. But their ecosystem was able to generate other huge businesses where you couldn't just value it relative to the total retailer market, because that's not what they do. And I think that's kind of the thesis on Tesla is like everyone shows the chart of like Tesla's worth more than every car company on the world combined. But
yeah,
my guess is there must be like there's arguments like the AWS argument. They got other things that
hmm
are equal to Tesla now. They could build 5 of those. So
hmm
when you do a short thesis and you compare it against the car market, that's just you're an idiot.
yeah, yeah.
So
No, I think
I
that's
just don't
true.
know, man. If it's got
I think I'm
momentum,
a
I'm buying
value.
it.
I mean, as much as a believer I am in Tesla all this time, I do think it deep in my heart, I'm a value investor too, because I think theoretically the value of any stock should be its future dividends. It
Yeah,
pays out in perpetuity, discounted back to
yeah,
present day
yeah.
value. And I can
Sure.
see a future where Tesla is paying dividends,
Yeah,
more than what Apple is paying today, substantially in,
yeah, yeah,
10
yeah,
years, 8
yeah.
years. And you accumulate that and you discount it back to present day. I could see the value anyway. So
Yeah,
I think,
100% makes
yeah,
sense. I just again that's a perfectly valid value philosophy. My value philosophy is just remember it's shaded by like my exposure to Ben Graham, which is just like cigar butt hunting. It's
mhm,
in the concept there is you always like when your value you want to buy with margin of safety. Like you don't want 10 things that need to go right to make
mhm,
money. You it's already in the stock price that 10 things are going to go wrong. You just need one of those to go right and you make money.
mhm.
Like that's just it's a different take on
Sure.
value. Um
It's like the glass is half empty versus half full or something, kind of. It's like
Yes,
just looking at it a little
exactly.
differently.
Yep,
Yep.
exactly. And I don't, I don't know who's right on it. I just do systems now, but
Yeah.
and I can
Yeah.
see both arguments on,
Yeah.
especially in this day and age with like massive scalability. But the problem is, remember, I started in 98, 99. And
Yeah.
to me, it's like deja vu because
Yeah.
like the same bullshit they say now, I'm like, am I in a time warp? Like I listen to these kids and they're like, they're saying stuff that like they used to say like in the 90s. And I'm like, it's I'm also a big believer in the human condition of fear, greed, and being an idiot.
Yeah.
And I'm so bullish on and so a believer that humans are just crazy and they always over extrapolate everything and they're sentiment driven. I don't know. I'm a curmudgeon, man.
Yeah.
I think eventually bubbles get popped, and as long as you can ride that bubble, that's all good. But you just want to have a plan, like a trend follower, do something to get out of that way. But that's just me,
Yeah.
I'm
Yeah. No,
not.
wise words. Yeah. Yeah.
Yeah.
Wise words. Well,
No.
I mean, this has been a real great to have you on. Lots of wisdom here. A completely different investment philosophy to what we do, and I love hearing about it. And what's like the best way for people to reach you if they want to reach you? And we'll put some information in the description and such. But what's the best way? Would you say?
I mean, just our website, alphaarchitect.com. If you're
Okay.
interested or know anyone that wants to, launch an ETF, God bless
Okay.
you. ETFarchitect.com. And then on Twitter, we're big on Twitter, just at Alpha Architect is my Twitter
Yep.
handle. So
Cool.
so those are the best places to reach out. And you obviously got my email. So if someone's got a question, just kick them
Sure.
on my way. I'm happy
Perfect.
to fill their mind with bad ideas.
All right. All right. Thanks. And Wes, you also
Yeah.
put this thing together called March for the Fallen, right? I mean, that's
Yeah.
every September. I've
Yeah,
tried to
actually,
participate a few times, but I've been bummed out from the COVID, and one year my wife
yeah,
was pregnant or whatever. But
yep.
real quick, what's
So
the 1 minute
yeah, it's
spiel on that?
funny you mention that, man, because actually today is the anniversary of one of my old roommates, this guy named Nate Krisoff, freaking
Mm,
badass. He got killed in an IED attack out
mm,
in Iraq. But yeah, so the basic concept of the March for the Fallen is that a lot of people, great people like you and I put their time in, they had bad run, and they KIA'd, and their families have to live with that forever. And the worst thing that happens to a Gold Star family, which is a family that loses a loved one in the service, is
mhm,
that people, like, they have so much pain and anguish and scars for the rest of their life. And the worst thing to them is to think that no one remembers their son or their daughter.
mm,
It's like ripping their heart out 5 times over. And I've
mm,
just seen with my own eyes, like just letting them know that, hey, we appreciate the sacrifice. We still remember your son or daughter. It just literally lights someone's day up times 10, man. So March for the Fallen is usually last week, September. COVID's bungled it all up. So we've been doing it virtual groups, but usually it's in the middle of PA at the National Guard Training Center. We have a big event there. I don't know what the COVID situation is. We'll probably continue to do virtual just so pod groups, like there's always groups around the country, 5 or 10.
mhm.
They just go out, it's 28 miles. You can do ruck march. There's different degrees
Yeah.
on it, but
Cool.
yeah, it's a great event. I highly encourage it. And yeah, we remember guys like Nate Krisoff, who literally died today. So
Mm,
and that's a super special thing for their family and everything. So
great. Great.
appreciate anyone who.
We'll put information on that. That's not, you can find more on that on your website too, I believe, alphaarchitect.com.
Yeah,
There's some
yeah, just
more.
Alpha Architect
Yeah.
/ MFTF. We
Okay.
have like a splash page, and you can get on the listserv, and we'll
Cool.
shoot out email and updates as they come in.